The hearing will resume. We have members coming in from voting, but in all fairness to our guests, we want to get started. We're very considerate of your time. We certainly appreciate you all coming. I want to, as my time next for comments, and I will start mine and then proceed with other members as they come in. First of all, I want to thank Dr. Galbraith for his help to me personally when we were faced with the early response in this fall in October, and we're putting together the first effort to recover and help our financial institutions. We were very concerned that there was nothing in that package, as some of you may remember, for what we considered the crucible of the problem, which was this extraordinary slide in home prices, the real estate market, and certainly due to outstanding mortgages and people unable to pay those mortgages. And so we needed to address that. There was a number of us who were very concerned about that. The leadership stopped the process. We couldn't get the votes there because they didn't have enough on foreclosure. We were assigned to go get a plan together to address that, and we put a call into Dr. Galbraith down at the University of Texas, and we were responded with that. And for that, Dr. Galbraith, we're very, very grateful to you. And I want to start my questioning off because I think we need to start right there on the whole issue of housing, home foreclosures, which is at the root of this problem. Much of what we put forward in that first effort, the key word is, remember, Dr. Galbraith, that we both secured that initial package was on making sure there was sustainability, that we could come up with a way to sustain individuals in their homes. And we had put forward the effort of patterning it after the HCL, the Housing Corporate Loan Corporation back during the Depression. We were able to incorporate some of those. We laid the foundation for it. And I'm very pleased that on the other issue of the moratoriums where we didn't get success, we did get success last week when we had the leadership of the banking community before us. We asked that they put a moratorium on home foreclosures till we got this in place, and they did. So we have the pieces in place. And Dr. Galbraith, let me start off with you on this question. Are we doing enough right now in the home foreclosure area? If we are not, what do you recommend that we need to do?
Well, first of all, Mr. Chairman, thank you for your remarks just now. I think that the housing plan that the administration has announced is a very positive step, and I think that the step that you just mentioned, having gotten the commitment of the major banks to a moratorium on foreclosures, is another very positive step. At the same time, the force that drives down housing prices is very inexorable. It's just a massive downdraft on the whole credit system, and of course it's spread far beyond the subprime and adjustable rate mortgages to prime credits, and put a great many people in the position where, from an economic standpoint, they're better off walking on their debts, and many, many more will do that. So I think we are at the moment where we should be pulling all these pieces together and taking a comprehensive approach. And the trouble with a comprehensive approach is that I don't see, there may be some way to do this without essentially checking on individual cases, case-by-case basis, and sorting the hopeless cases from the sustainable ones and the honest cases from the fraudulent ones. But if there is a way of doing that, I certainly haven't come up with it, and I think that we need to adjust our ideas to the scale of this operation. As I've said before, the HOLC took 20,000 people to handle 1 million mortgages in the 1930s. It's a very big job, and was going to require a lot of effort.
Do you believe, Dr. Galbraith, that given the fact that we have $75 billion in this new program that the President's put forward, do you believe that that is sufficient going forward, especially given the fact that it is estimated that in the next 3 years, 2 to 3 years, there will be 9 million families in homes in default of foreclosure?
Well, my understanding is that the thrust of the President's program is to protect people who are shy of the threshold of foreclosure at this moment, so that people whose homes are too deeply underwater are not eligible for example, the extension on the limits of mortgage renegotiation. And so I guess my answer to that is there is still a very large hole in the housing problem which has not been dealt with. And it's probably not been dealt with because it's very much the most difficult thing to deal with, but it's still, in my view, essential if one is going to shorten the period during which this excess supply of housing is acting as a drug on the market and driving down the asset prices.
And finally, I know my time is short. On my final point of my question before I turn it to one of my colleagues, to each of you to give, if you could each of you give a very succinct answer to this question. We are moving on the housing front, stabilization. Are we, excuse me, do we have our hands around this stability of our banking system? It concerns me that we have some debate over an issue of what we call, various people call it various things, but let's just deal with it as it's being called, and that is nationalization of our bank. And would you, how does each of you feel about the extent of the government's role in the banking industry? And are we close to that? And specifically, I'd like for you to comment to the Citigroup situation. I asked the Fed Chairman Bernanke that on yesterday. And as is the case with so many of our Fed chairmen, out of great respect, your answer sometimes comes back to you in a way that even confuses the question that you put, to get a clarity of the answer as to whether or not we're approaching nationalization. But I would like to submit you to the point in the front page of the Wall Street Journal on yesterday. The CEO of Citigroup made the comment that he was in touch with federal regulators and federal officials from the Fed, and the essence of the article was that he was asking, in effect, that they not make decisions regarding their senior management. That tells me right there that he who makes a decision about who stays and who doesn't stay in terms of running the bank is in charge of that bank. So I want to get an answer from each of you. Are we at that point of some form of nationalization? Is that what we are approaching? And the other thing, is it necessary in order to deal with the scope and the magnitude of the problem, I think vis-a-vis what they did in a couple of our European countries? I'll start with you, Dr. Binder.
Well, very briefly, as I said in my testimony, I don't think we're at that point yet. I am hopeful that we won't get to that point, but I think we need to understand that we might get to that point, because one thing we've learned about this financial crisis is it keeps getting worse than we think. So I wouldn't rule it out, but I certainly wouldn't be eager to go there now for reasons that I outlined in the testimony. As to Citi and others, I wouldn't pull out Citi for special treatment other than it seems to be first in line and is talking to the government. I think, and there are many, I think the right approach is the so-called good bank, bad bank solution. Now, that's not a well-defined. There are many variants of good bank, bad bank. And I'd actually point out that the first time this was actually used, I think it was in 1990 with Mellon, they did it themselves. It was a purely private operation without the government. Now, I think the holes in some of these balance sheets that we have now, especially if we mark to true market valuations, is so large that to make a good bank, bad bank solution to any of these large banks work now, public monies would be needed.
I see.
When you hive off the bad stuff into the bad bank, you start with an institution that has negative net worth. You got to bring that at least up to zero or to some small number. And I don't think the private capital, frankly, in this state of the economy is going to be there. So it'll need public funds. But that's not nationalization.
Just very briefly, I think I listened to part of Chairman Bernanke's testimony the last couple days, and I thought it was actually very helpful in clarifying that nationalization was not, as commonly defined at least, not the way he would go about this, and I think markets responded positively to that. Again, it's talking more about these large, complex institutions because the FDIC frequently is taking over banks before they're sold off. So I thought his testimony was maybe your standards here are too high, Mr. Chairman, but I thought it was very clear about that. And also, with respect to the Wall Street Journal article about Citi, it seems to me that's reflecting something very common today. The government is involved. It causes all sorts of issues, political. The government is not good at managing private firms, in my view. New York Fed is now managing AIG. Look what's happening there. So it's something that we should be staying away from as much as we possibly can. And I'm not surprised when I read the tension in the Wall Street Journal. I'm sure it's true in many of the other institutions. And then finally, I think now the most important thing is to try to get some clarity about what our policy is. And there's people really clamoring, if you like, for clarity. So whatever it is, let's get on with it. And I think that'll be probably the most important thing to do to get the stability you're asking about.
Thank you, sir. Dr. Galbraith?
I take a different view. When a bank is troubled, when it is threatened with insolvency, let alone when it is in fact insolvent, the federal government, the regulatory authorities, have the responsibility to intervene to protect the depositors who are insured by the FDIC. And the FDIC is charged with doing that under the law. A pass-through receivership is the standard mechanism for the resolution of these problems in American law and practice. It was done dozens, scores of times with savings and loans in the late 1980s, early 1980s. It is being done with banks as we speak. It was done under the Bush administration with banks. It involves protecting the depositors, putting in new management, and the reason you want to do that is that new management is required and can be recruited from the banking industry, but is required in order to get a clean audit so that you can effectively separate the bad assets from the good ones, and so that the public knows the extent of the hole in capital and the extent of the potential liabilities to the insurance fund. And then you go about arranging for the bank to be reorganized for sale. It may be merged, it may be sold, it may be broken up and sold. It may require infusion of public money. But until you have gotten a clear assumption of responsibility and a clear accounting, you won't know exactly what to do. The FDIC has experience with this, is in general competent to do it, although obviously doing it with very large banks is a daunting challenge. And that should be their call and their responsibility, free, I believe, of political interference from the Congress, for that matter, from the Treasury Department. It really is a professional judgment. And that's why I don't like the term nationalization, which implies a political decision. This really seems to me to be a professional regulatory responsibility.
Very good. Thank you, all three of you. Very interesting. Mr. Green of Texas.
Thank you, Mr. Chairman. Friends, I will move as quickly as possible because I have a number of areas that I'd like to cover. And I'd like to employ the voir dire system wherein I ask you to simply raise your hands. This way I'll get a quick indication as to where you stand. So let us start, and thank you for coming. Let us start with Chairman Bernanke indicating yesterday that we were on the verge of what may have been considered a financial meltdown. Do you agree that we were on the verge of a financial meltdown last year? If so, would you just kindly extend a hand into the air? This would be helpful. Okay, I have one disagreement. Mr. Taylor, could you, as tersely as possible, indicate why you do not think that we were on the verge of a
Well,
financial
the word
meltdown.
is just so hard to describe. Didn't hear his testimony. I didn't know the context. We're in a very serious financial crisis.
Okay, well, let me ask you this. At last year, were we in the midst of a very serious financial crisis? Is your answer yes or no?
Well, it worsened
I
dramatically.
borrowed your language, by the way.
Yes.
Okay. Now, given that we were in this serious financial crisis, do you agree that the TARP funds were spent such that they had a positive impact on the financial crisis? If you could kindly extend a hand into the air, it would be helpful. The TARP funds, were they spent such that they had a positive impact on the financial crisis, the possible meltdown?
Are we allowed to say positive but poorly spent?
Poorly spent, but positive impact.
That would be mine.
Okay, poorly spent, positive impact. Mr. Taylor?
No, I didn't see a positive impact.
Positive impact, sir?
I'm right on the fence on that one, as Alan is. I think you can point to specific positive effects, but in general, it could have been done much better.
Then let me follow up with you. If you concur that we were on the verge of a financial meltdown, and I assume that you do not conclude that currently we're on the verge of a financial meltdown.
No, my view actually is that the meltdown had already occurred.
That we'd already gone through the financial
yes,
meltdown?
The problem here was the extraordinary explosion of these toxic instruments, and that problem still sits in the banking system. So the core of the system has melted. It's the question of whether the containment structure is broken.
All right. Let me move on with a few other things. The concept of the bad bank, Dr. Blender, you indicated that you would employ this. We did not hear specifically from the other panelists as to where you stand. Mr. Taylor, where do you stand on it, please? Oh, I would not.
No.
Okay. Dr. Gilbert? Albreth, excuse me.
The good bank, bad bank?
Yes, sir.
I think the reorganization of the banks should be the responsibility of the FDIC.
Is your answer no? I have other questions. That's why I have to
they will isolate the bad assets and reorganize.
So is your answer yes or no? I'm not sure. Sometimes when people finish, I don't know whether they've said yes or no.
Well, I'm not entirely sure I've understood the thrust of the question.
The thrust of the question is this. As
assets
the concept exists now,
Yes, you isolate
good
the bad
bank,
assets.
bad banks, the bad bank to take in assets, acquire these assets, these toxic assets, is that something you would see as doable?
As a part of reorganization of failed institutions, yes, that's what you do.
Okay. Moving to another area, let's talk quickly about judicial modification of mortgages. Is as proposed, which is a retrospective approach, not a prospective, but a retrospective approach utilizing judicial modification, is this a part of one of the tools that we might utilize? And we'll start with you, Doctor.
My brief answer is yes, though it's not my favorite approach. But if
Okay, as a last resort, only after the mortgage, the person who happens to have the mortgage has made an effort to settle with the servicer who represents the investors.
yes,
Okay.
my preference would be to take this out of the realm of the bankruptcy courts. But
Yes.
if this is what you just said is actually on the congressional table right now,
Yes.
it's a lot better than nothing.
Okay. And I must move quickly, Doctor.
No.
Dr. Taylor, no? Okay.
Yes.
Yes. Let us move quickly to one additional thing, and maybe I'll be able to come back and get your rationale as to why not, Dr. Taylor. But credit default swaps, they've almost gone off the radar in terms of being a issue de jour. Let me ask you if this is something that is still lurking out there that could possibly overwhelm us, in the sense that my understanding is that these credit default swaps can total more than what the entire stock market happens to have within it currently. So, Doctor, is this something that we've got to give serious attention to?
I think absolutely. It was just in the paper the other day that AIG is liable to be in for yet more money because of yet more losses on credit default swaps. That's not over.
Dr. Taylor?
Yes, one of the proposals to create some kind of central clearing mechanism, really what we need.
Yes.
Dr. Galbraith?
Yes, definitely.
Thank you. And I'm sorry I had to move so quickly, friends. And the final question will be a sort of a general question. We talked about the Homeowners Loan Corporation from the 1930s. That paradigm seems to have been somewhat efficacious at the time. is there a means by which we can employ something similar at this time as a tool to help us through this crisis? Dr. Blender?
Yes, I think you did. I think the Home for Homeowners was a variant of the HOLC. The HOLC made the government the banker and actually owned the mortgages. The Hope for Homeowners made the government the guarantor, not the owner, but the guarantor.
I understand, but I will follow up with this. It was a voluntary system, and
So was the HOLC.
we didn't get a lot of participation, I understand.
That's
but
right.
Because of the lack of participation in the system, the question would become, how do you tweak it so that it is utilized? Because while it's a great idea, if nobody embraces it, it's an idea unused.
I couldn't agree with you more. I learned in the break that this committee has actually passed the liberalization or a tweaking of that. I didn't even know that.
Yes, sir.
And I applaud that. I think what it also needs is some form of extensive outreach. The sad fact is, in all the government's programs, I mean, this is true even of food stamps and things, a lot of people that are eligible for these programs have no idea they're eligible. They don't even come in and ask for them. And so this goes to your question of the take-up rate. So I think you probably need to add to that some substantial outreach.
Okay, thank you. I'm going to yield back, but I'd like, if I may, to get answers from the
Familiar with
two
the
remaining
modification of the bill that you're referring to, so I think I'll just pass.
panelists. Thank you.
Well, I'm in full agreement with Alan Blinder on this.
Thank you, Mr. Chairman.
Dr. Galbraith, did you comment on that? Did you have a chance to comment on this?
I did, yes, I said I'm fully agreed.
Very good. All right, thank you. Gentleman from Missouri, Mr. Cleaver.
Thank you, Mr. Chairman. I think, Dr. Blender, you earlier mentioned how you thought using the term nationalization of banks was negative, and I agree with you. The problem we have is that, frankly, we are not in charge of how issues are framed. So people who are opposed to what we're doing begin to talk about nationalization of banks. It gets out. I don't think you can find any instances where the chair or anybody in a responsible position in Congress talked about nationalizing banks. I think that's dangerous also. That, I mean, we are now inserting into the lexicon bad bank, good bank. It's going to be a problem as well. I am hopelessly on a crusade to try to stop it, but I lost a long time ago. But I guess crusades are supposed to take place with the possibility of not winning. I think we're headed in the wrong direction on that, and it's going to be out, and then our constituents are going to be raising questions about, well, is this a good bank or is this a bad bank? And you have some kind of bad experience. It's a bad bank. It's not going to be a good thing. The Treasury, I think, may have made a mistake. Since they are I think on this issue, the framer. But anyway, that was some meaningless rambling about our lexicon and won't get us anywhere. What I want to talk about, and Dr. Galbraith, actually I want all three of you to be engaged in it, but someone raised the issue earlier about our debt to China, which actually is not as great as our debt to Japan, but we're moving toward $2 trillion of Chinese holdings of U.S. assets. And the question is constantly raised when I'm in my district about what happens when China decides they don't want to acquire any more U.S. paper. And my answer is usually that the Chinese have no other options for investments, and that they will, in all probability, want to continue to invest. That we might have a problem of interest rates rising if they do become weary, and then we'll have to go with the interest rates in order to continue to get the investment. Is there another scenario that you would like to add to what I've just said?
I think the Chinese may not be very happy with their portfolio position, but they don't have much choice about it. If they want to sell exports to us, they're going to earn dollars. They have to do something with them. They accumulated a lot of those reserves, actually not from trade, but from converting dollars that were brought in to invest in the real estate and the stock market in China. And that's also something that they did as an incident to other public purposes that they had. So I don't think it's likely that the Chinese are going to suddenly adopt a policy of active dollar dumping or moving away from dollar assets. If they chose not to renew their securities, we would simply debit their securities account and credit their reserve account. They have the dollars. They would have to sell them off to somebody else, and probably the Europeans would end up with the dollars. But all that said, it just seems to me that it's not immediate and maybe not even a distant problem that the Chinese or the Japanese would prefer to hold euro or some other major currency as a reserve asset than the dollar, because the vulnerabilities of the banking system in that part of the world are at least as great as they are here, and the credits of the government, the security of the governments that are behind the euro is much less than it is here.
Well, is there any concern, and I've not been able to find the answer to this question, is there any concern that the Chinese actually are holding substantial securities that were acquired from Fannie and Freddie, which are actually subprime mortgages? And that has not, I've not seen any information on whether or not that has in fact happened with the Chinese investors.
I have not either. I know they hold a lot of agency debt, but I don't believe that they've been, in the official accounts, holding the privately securitized subprime debt. But that's a question I don't have an answer to for sure, as a point of fact.
Thank you, Mr. Chairman.
All right, thank you. Gentleman from Colorado, Mr. Perlmutter.
Thanks, Mr. Chairman, and gentlemen, thank you for your time today and your sort of advice on these things. I got a couple sort of macroeconomic questions. First is, we sort of divided this thing up into three parts. One was to try to stabilize the financial markets, which some positive effects out of TARP could have been done better. Second is, in my opinion, stimulate the economy, get it going again. Third is to restore confidence in the system. We've got regulations to deal with, and so we're going to have a hearing soon on some of the regulations that may have been eliminated in the past and some that are in place that seem to be compounding problems overall within the system. So my question to the three of you, let's start with mark-to-market, which seems to get a lot of conversation here, and I'm looking at it closely. Within the overall economy, do you all have an opinion on whether we should be maintaining on a daily basis, some mark-to-market that banks need to collapse their capital or not? Anybody have an opinion on that? And if you want to reframe the question, I'm happy to have you do that too.
I'm generally very favorable to mark-to-market, and I think it's much, while there's a lot of debate on this, as you mentioned, between whether it's part of the problem or part of the solution, I'm much closer to part of the solution. We need to know how big the balance sheet holes are. When I say we, the markets need to know, and then you can start doing things. That said, there are at least two things that I think we should think of as, I don't really mean exceptions, but qualifications. One is banks have always had these held-to-maturity accounts where most loans are, for example. They're not going to sell these loans. They will hold them to maturity. They reserve against them, which is the version of mark-to-market that you get there. I don't see any big need to change that. Now, reserving might be inadequate. I mean, that's what supervisors are supposed to be watching to make sure there's enough reserving. The second thing, which is a much knottier problem, which we really hadn't had to face until recently, is what do you do when, so to speak, markets disappear? That is, if you have an asset that's ask 60, bid 20, bids and asks are supposed to be right next to each other, but when it's 60-20, the whole notion of mark-to-market becomes a difficult one to deal with. And I think I don't have a fixed answer to that. But some people have said the answer is simple: you mark it to 20. I'm not so convinced that that's the right answer, and I think it needs a lot of thought.
Okay, thank you, Mr. Taylor. Dr. Taylor?
I don't have too much to add to that. I think mark-to-market, it provides the information you need, but in some cases where the securities are going to be held to maturity and it's in a bank, then there's other ways to do it. I think there's some sense of forbearance here is what people are looking for, and I'm very positive about that.
Dr. Galbraith?
The argument against marking to market the subprime mortgage-backed securities has been that the market is somehow artificially depressed relative to the real value of those securities. I'm very suspicious of that argument. I think it's very unlikely that even if you did take them off the books of the banks at a guaranteed value that was higher, that the Resolution Trust Corporation that would eventually sell them would be able to get rid of them for anything higher than the market price. And the reason is that I suspect the markets understand that there is, in the case of these securities, practically no way to know what the underlying risk really is because the documentation that you would normally rely on isn't present. Okay. And that seems to be a real problem with modifying mark-to-market in this particular circumstance.
All right. Second question, which is similar to a mark-to-market, is the cram down. I mean, that is marking to market. If we, and again, on a macroeconomic basis, and this is, I don't know exactly how many people will take advantage. If we do a cram down in a Chapter 13 and we have 10 million potential foreclosures out there, I don't know what the number is, maybe you all know, what's going to happen? Do you have any opinion of what will happen to the system if everybody takes advantage of a cram down? Start with you, Dr. Galbraith, and we'll work backwards. So,
well, if you replace a completely unmarketable security with a mortgage which has a lower return, but which in fact is documented, has some capacity to be sustained, you might actually move to a better market environment after the cram down than before. And that's what I think you would be hoping to accomplish by putting these mortgages on a sustainable 30, 40 year, 4% basis if you can do it.
Yeah, I mean, any if you like forced cram down like the one I think you're thinking about raises questions about future lending and what's going to happen in the future, especially if it's retroactive. So I'm very cautious about any kind of legislation like that.
I actually think going forward, and this is, I think, not the current congressional proposal, I would like to see homes treated like vacation homes and other assets. It's not the case that you can't get loans against assets that can be crammed down in bankruptcy. All assets, basically, all business assets can be crammed down in bankruptcy. It probably results in a couple more basis points, I don't know, on the cost of credit. That's going forward. The retroactivity, I think all of us are very uneasy about retroactivity. I am. I mean, it should be a general constitutional principle. You don't pass retroactive laws. This looks to me like an emergency. I think there may be better ways to do it, but as I said in answer to another question, if that's the proposal that's actually on the congressional table, then I would support it, though it's not the sort of thing that generically I like to support.
Thank you. In all fairness to the proposal that is on the table, it's narrowly drawn. It doesn't apply to all of the mortgages that fall into foreclosure, and it would not extend beyond the inaction of the bill. The intent of what we are trying to do in grappling with this issue is to try to put a floor. At some point, you have to try to put a bottom and a floor on, and these are in the most desperate situations. And then certainly there's a fairness issue that for the wealthy who can have this benefit for their second home or third or vacation home, here you've got the primary residence. And then the other issue is certainly going back to, we mentioned earlier with Dr. Galbraith, we've got to find a way of sustainability to keep people in their homes. This cram down in this bankruptcy is a grappling issue, and hopefully we can get it right. I think we'll come back next week, as you know, Ms. Palmer, and try to wrestle with it again. Thank you very much. Now we'll turn to the gentlelady from Ohio, Ms. Kilroy.
Thank you very much, Mr. Chairman. Thank you to our guests. I've been very interested in your testimony and the various ideas. It challenges us to find the right pathways to go and to do our work here in the Financial Services Committee well and appropriately, not allowing the regulators to do the work that they are professionally trained to do. I thought those were very interesting comments. Many of the questions that I had come prepared to ask have already been covered ground by the committee. But I wanted to go to some of the thoughts and ideas that are a little bit moving away a little bit from issues like retroactivity, which we could debate, and cram downs, and talking about some of the ways that we can do to restore long-term financial stability to our country and to our economy, measures that we can take a look at big picture, infrastructure, Social Security, health care. I'd like to ask the panel to maybe revisit that a little bit before we adjourn today.
Well, I think with earlier questions about this is whether we should be addressing something like Social Security now or wait till later. And my view is, yes, now. We should be getting on with these things because they demonstrate that we are concerned as a country with our fiscal imbalances. That's a huge imbalance down the road. So I would be of the view that let's get started with those now. That's actually economically one of the easier ones. It's politically very difficult, but I think it would demonstrate a great degree of confidence, if you like, that the government is taking on something like that.
I agree with that very much, and I would put just a slightly different nuance. Given the incredibly difficult issues that the Congress has been grappling with now, the huge sums of money, and it's not over, Social Security has actually become the low-hanging fruit. This is an easy issue, actually. You do not have to do horrific things to get Social Security back into actuarial balance. Secondly, the natural things to do, because Social Security is running a big surplus now, it's an inherently a long-run problem, will be clipping benefits, if you want to use that term, and raising revenue down the road. It's not at all urgent to do it now. So the Congress can enact now fixes that will take place years from now. That's what the Greenspan Commission did in 1983. That's not nearly as painful as appropriating $1 trillion to rescue banks today. I think it would send a terrific signal about this seemingly contradictory position that we're going for huge deficits today but fiscal responsibility tomorrow. That would be a tangible manifestation written into law of a modicum of fiscal responsibility tomorrow.
I'm in very deep disagreement with my colleagues on this point. I can see no economic reason why, going forward, we should be concerned about the balance between a stream of revenues called payroll taxes and a stream of obligations called Social Security benefits. If you're concerned with that question of balance, you could solve that problem. It's not a problem, but you could solve that cosmetic issue by assigning some other tax source, the estate tax, as former Social Security Commissioner Robert Ball had suggested, could be put into the trust fund. You don't need to solve this problem, this alleged problem, by legislating today reductions in a core benefit on which 40% or more of the American elderly rely for practically all of their income, and particularly not at a time when the other sources of income and wealth that support the elderly population have taken an enormous hit. Housing values, stock equity values, and the interest income on cash holdings all going down simultaneously, Social Security is more important than ever as the bulwark of the middle-class standing, the non-poverty status of the elderly population. So I would hope very much that we resist the temptation to make this what is essentially symbolic and political gesture at this time or at any time. At the same time, on the broader question that you raised of whether one should be treating this as a long-term or a short-term problem, my view is this crisis is the opening act of a long-term transformation of the economy. And we are going to need, as we think about building the economy back up from the calamity through which it's passing, we need to think about this from a long-term perspective. And one of the defects of what we've been doing so far has been the assumption that it will recover within 2 or 3 years, and therefore we can limit the scope of action to the shovel-ready projects and the short-term expenditures. I don't think that's going to work, and I think we'll only discover over time whether I'm right or not. But if I'm right, then the right approach is to think about the public investments that are truly transformational and begin to do them now, to build institutions like a national infrastructure bank, the Dodd bill, that can finance that transformation going forward, and to build into the project the kind of development of new industries that deal with our energy problems, with our climate change issues, with the creation, in some sense, of the living space that we want to have for the next generation. That seems to me to be, if we do that, we will be remembered for having made an opportunity out of the crisis.
Thank you. Yield back.
Ladies, time has expired. Thank you very much. On behalf of our Financial Services Committee, on behalf of the Congress and the American people, we really thank each of you. We're at a critical, crucial point in the history of our country, and the hopes and aspirations of millions of Americans and our children and grandchildren to come rest on what we do here today. And your intellect, your ideas have been very helpful to us as we move forward to grappling with these very monumental and critical issues. You know, it's the tough times that determine the character. We've had tough times in our nation before, and that's why we have a tough character that has made us a great nation. We thank you, Dr. Galbraith, Dr. Taylor, and Dr. Blinder. This meeting is adjourned.